on the global economy, it is hard if you stop reading the political news and just look at the financial and economic news. It's hard to be very pessimistic. You can see right now, this is just my actually I'll show you 8 charts that I think are kind of a quick picture. If you only look at 8 charts, what is it you want to see? U.S. jobless claims, U.S. manufacturing, new orders, and inflation. We can talk about inflation a little bit later, but it's generally a remarkably good picture in the United States. If you go abroad, China is obviously a very important driver of global economic growth. Things have been slowing down both in terms of retail sales and industrial production. But China has plenty of resources to manage this, I think, and that's another topic we can discuss if you like. But overall, the global economy continues to benefit from very strong growth in the United States. I think a pretty optimistic picture in Europe. And in spite of the noise around trade, you can see exports in Korea are picking up, and the German IFO index, which is, I think, generally a good proxy on global trade outlook, is quite positive. I'll run through a couple more charts. I won't talk about all of them, but again, it's just to underscore that on the economic front, the IMF does a World Economic Outlook every year and makes forecasts for 193 economies. For this year, there are only 8 where they are projecting a recession. Venezuela is the largest. The others include Puerto Rico, Swaziland, and Equatorial Guinea. So the IMF, for whatever it's worth, is projecting things to continue both this year and next year to be quite good. I think what I would highlight on this chart, I think what I find to be an interesting ratio is the copper to gold ratio, which generally tracks with U.S. Treasury yields. Again, good growth, not a lot of inflationary concerns, I would say. Probably better on this next page. No, I guess it's on this page. Just expectations of economic data. The top middle chart is coming in more or less according to expectations. So very little sort of surprise one way or the other right now. The big worry, of course, is that we're all looking at the same data and more or less optimistic, and we're probably missing the kinds of things that come along and put an end to these kinds of stories. Generally, I'm not of the view that cycles die of old age. Like the human body, they get older and more susceptible to viruses and shocks, but there's no reason why the current cycle can't continue to go on for some time. Again, I'll run through quickly the US, Europe, and China and Japan, and would just draw your attention to, again, inflationary expectations in the top middle there. The bottom, you can show wage growth has been accelerating, but other parts of the consumer basket are showing very little signs of pressure, whether it's in housing, in commodity prices, or in consumer spending. And most importantly, economic inflation expectations remain very low for those surveyed in the United States. So it's hard to imagine that the Fed is going to break out of its current slow tightening pace this year and next year. We will get another important picture from them on next Wednesday, the next FOMC meeting of the Federal Reserve. The governors will announce their dot plots for 2021. So this is their expectations going out another year. And so I think the market will look closely at that to see if there's any change in what the governors are expecting. The big story in the United States are the bottom middle and bottom right-hand charts. Corporate profits are very, very strong, partly driven, of course, by tax cuts that were passed last year. Earlier this year. It seems like a long time ago. corporate profit margins had been very high, or have now gotten this extra support. I think what's very important to watch going forward is whether or not this is a temporary boost or it is more durable, in the sense that there's obviously a very big one-off temporary boost, but the ability for companies now, the incentive for companies now to invest in capital goods will, at least for the next few years, should at least for the next few years, improve their profitability and could, as I say, push this growth cycle out a little bit further. There is, of course, the question of what happens to the U.S. government's finances and balance sheets during this period. I like to say that this is President Trump's gift to the economics field, because we are testing the proposition of what it's like to inject massive fiscal stimulus at the top of the cycle, which is not something the textbooks tell you about, but we're going to give it a try, and you'll be able to see how that works out. I have my longer-term concerns about that. In Europe, Europe is always lagging the United States. It continues to lag the United States, but I think it's not such a bad story. If you look at unemployment in Germany, which has been coming down, if you look at industrial production in Germany, inflationary expectations remain tempered. The ECB has been, of course, behind the Fed, lagging the Fed, both in terms of when it moved to quantitative easing, of course, but also when it has been, as it has been withdrawing accommodation. We expect them to do what they are currently saying, which is that they will stop, they will reduce purchases next month, stop them at the end of December, and not really start hiking rates until well into the end of next year or the year after. But having said that, Europe, particularly, as I say, Germany, France, Spain, has a pretty good story. And I think we can expect, valuations there are lagging. That's probably a good place to look if you're looking for investment. The big story there are two big stories in Europe, having to do with the UK to the north and Italy to the south. You've been following the drama on the British negotiations. I suppose my view, having followed Europe for quite a long time, is that there will be some deal done, at midnight after the last final deadline is passed, but before the financial markets open, and that they will cobble together a relationship with the UK, which is cumbersome and difficult, but will more or less allow current business to continue as it does with the continent. But that's clearly going to rile or lead to some volatility in financial markets for the next couple of months. In Italy, there is a different issue having to do with the government and its fiscal promises. It's a very strange coalition, as you know, between far-right and populist forces, where they, again, want to both cut taxes and increase spending at the same time. Italy, I think, is one of those countries that gets, in some ways, has a bad reputation, partly deserved, but partly not deserved, in the sense that it is running both a current account surplus and primary fiscal surplus. After interest payments, they take in more than they spend. And I think there is certainly some wiggle room for this government, if they follow at least what the Prime Minister and the Finance Minister are saying. There may be some increased fiscal spending, there may be some name-calling back and forth between Rome and Brussels, but again, I would expect that they will also come to a deal. Having said that, if they don't, and if Italy if Italy's spending or borrowing costs increase, that's not the end of the world. Their debt maturity is quite long. They can afford a rise in interest rates for some period of time. What they cannot afford is to lose access to the market, because the economy in Italy is so big, its borrowing needs are so large that if, unlike Greece or Portugal, there is just not enough money in the Eurozone to bail out Italy, that would really be the end of the Eurozone. Again, not my expectation, but that is, I think, where we are. In Japan, the story looks very similar to the way it has looked for probably 10 years. Low inflation, low growth, but there are signs of some, improving wage growth. At last, in Japan, there are some signs of good corporate profitability. They still are not able to get any inflation to pick up in the Japanese context, and so that has been a problem. But the other story in Asia, of course, is China. China is slowing down significantly, but it is also a story where things are, it feels, at least right now, that the government is in control. They have been taking accommodation out of the housing and real estate market, where there has been excessive borrowing and property price bubbles. But they have been, at least more recently, injecting liquidity into the banking system. I think it was just yesterday that the Prime Minister announced some tax benefits that would help boost consumer spending. And what they have not yet done, what they probably will do if they need to, if the tariff wars really begin to bite on Chinese exports, they of course have ways of bringing down the currency. There is a risk, if the currency appears to weaken too quickly, that it will start leading to much more pressure for outflows from China. But again, that's not our base case right now. The real longer-term concern in China is the lower right-hand chart you can see here, where the stock market has sold off, I think, about 20% this year, if not more. Industrial profits have been very low. But not to say that this is the bottom. It feels like the government has a lot of both fiscal ammunition as well as monetary policy support or tools to be able to manage that transition. So I would finish here, because I think that's my last slide, by saying the things we're looking for over the next month are economic, financial, and political risks. The economic risks are that this very strong economic growth story, which has been sustained through enormous monetary support, is not durable. So that's, I think, a very important space to watch. The financial risks have to do with monetary policy that is being withdrawn at a different rate in the major economies. So the US is way ahead, Europe is in the middle, and Japan is further behind. And the differential shifts in monetary policy, I think, make it very challenging for investors. You see, run up in the dollar that no one had really expected. You see a lot of different cross currents. And then, of course, the political risks are high in everybody's mind, whether it is more isolated in Italy or Britain, or just general trade tensions between the United States and China, which I think are likely to get worse before they get better, and really do cast a cloud on the bright political outlook that we see right now, the bright economic outlook that we see right now. So that's my quick review of everything going on in the world economy, but happy to answer your questions or whatever is on your mind.
Thank you very much. We, as we are in Moscow, we live on kind of peripheral of the world. So the questions...
It's a very large periphery.
Yeah, it's a very large periphery of the world. So the questions would be rather childish, I suppose. Here the new news come late, and we need better explanations of them. So first question would be, many English-speaking media are talking about the new bubble in the credit area in the world, particularly in the United States, mostly concerning the SMEs and industrial lending. Could you say a couple of words about that?
Yeah. So, in fact, high yield investing is something where Barings has a very large team. We do a lot of work with mid-sized, smaller debt issuers. We actually also have some business where we do provide some direct lending to mid-sized and smaller companies. And that is not just because we have such fabulous investment teams, but also because the regulatory changes and the business changes in the big money center banks have made it unprofitable for them to provide credit to some of these mid and smaller sized firms. So you do have a lot more money coming to these companies through different pipes than we had before the crisis, before the Lehman crisis in 2008. What is difficult to know, and what we see, at least on a micro level, the firms that we are lending to, the firms that we are, whose bonds we are buying, is that the covenants, the legal covenants in a lot of these bonds, in a lot of these loans, have been weakened because there is a lot of liquidity, money chasing into that area. But the companies themselves are quite profitable. Their balance sheets are not stressed, and there will obviously be some that fail or that are not able to pay back their obligations. But for the most part, we think that those companies are healthy. The other side of it is if the borrowers can continue to afford to borrow, the lenders are not banks. The lenders are pension funds, private equity funds, and endowments. And so if the cycle turns, unlike previous cycles where banks had to pull back their loans, these loans for the most part are locked up, or at least the funds that are investing with us are locked up for a period of time. And so we wouldn't expect the very sharp downturn that we had last time around.
Thank you. Another question obviously is connected to the trade wars. I'm trying to do the simple math, looking at the GDPs and the sizes of the export and import turnover and the size of the duties imposed. I don't particularly understand the hype about this war. It's like 25% of something which is 10% of the GDP is 2.5%, essentially going into the same pocket but different way. The Chinese would accommodate the new prices, and the consumers of the US would accommodate the new prices rather quickly. What's the matter with this wars? Why the value of that in the media is so high?
Well, I think two things. You're right to look first at the math, because the United States is a very self-contained economy. Our exports are very low relative to GDP. China, which had been very dependent on exports, is much less dependent on exports today. And the numbers we're talking about are very low. I think there are two things, though. One is it's not good economic policy, and it creates the basis for longer-term distortions in the markets. And if you're looking for something that would undermine all of this good feeling we have in our financial markets, I think there is the sort of follow-on effect that, if profitability starts to waver, if inflation starts to pick off, and then on top of it you have these escalations of tariffs, that has a potential for leading to the sell-off. I think the broader issue, though, is it just becomes not so much looking at trade flows, but looking at investment flows. Is the United States a much better, more attractive place to invest with these tariffs and retaliation against our exports? We've seen various companies announce bad earnings and blame it on tariffs, which I think is a little too convenient this early in the cycle. But having said that, if you had planned to set up a big factory in the United States and now think, well, maybe what I'm going to build in the United States, I can't export as easily to Europe, you may have to rethink that. And I think it's the unpredictability of those longer-term plans that will be damaging.
Sounds very Russian in itself. We also have a very unpredictable economy.
Thank you.
The emerging markets. If I tell you that we are in a situation where the the technological companies outperform the common companies in the markets and in the industrial world, and the emerging markets are chasing the developed markets with the high growth, but the high growth is being slowed, and the balance sheets of the emerging markets are excessive, and we face the problem with the repayment of the excessive debt which was given to the emerging markets. Before, you would probably tell me that it's 1998 or today. Is there a big difference between these two periods, 20 years before and today, and what's the difference?
Well, these economic cycles, everything is the same and everything is different. What is the same, you have clearly pointed to. I think what is different are a couple of things. One is most emerging markets now have flexible exchange rates, so that those are not the pegged currency rates that got Asia into trouble, for example. Most of I shouldn't say this, be careful how I say this, but for the most part, the debts are not excessive government debts as much as they are in the private sector, which doesn't make them less dangerous in some cases, but I think for the most part, they are well contained and well advertised. And I think the pressure on emerging markets that we have seen lately has come from a lot of idiosyncratic stories. Turkey, Argentina, Russia, all are facing very different political and economic challenges, all combined with a dollar that is getting stronger and interest rates that for the past 6 months or 9 months appear to be going up faster in the US than anywhere else. So I think that's the near-term picture that we've seen in emerging markets. I'm not sure, and on our recording, I never like to make any predictions, but I'm not sure that we're headed for more than just a near-term pressure on emerging markets rather than a crisis down the line.
And we talk about the idiosyncratic issues. I've got a question right before the meeting today about Turkey and Argentina, whether it's a buying opportunity or something we should stay away.
Well, it is a buying opportunity. I don't know if it's a buying opportunity today or in 6 months. That is the difficult question, of course. What I think is interesting about Argentina and Turkey are that they are, in some ways, very different. They're both in trouble, but they're both in trouble for very different reasons. Argentina has a government that is trying to do the right thing, that is engaged with the IMF, but it has in many ways overpromised what it will do. It has doesn't have the political power in many ways. The president of Argentina can't deliver a lot of the things that he has been promising. And it is a country that as it has gone down this path, it is revealing far more distortions about the Kirchner era than we had fully understood. The suppressed inflation, the weakness in the banking system, a lot of those things have come out in the near term. Turkey is sort of the opposite in the sense that the president has too much power. The president has been resisting doing the right things. But in both countries, you've had a currency sell-off dramatically. At least in Turkey, the government seems to be well on top of its debts. Its debts are fairly low. The debt problems are in the private sector. And if the recent signs of raising interest rates, of pushing through some economic reforms are real and continued in Turkey, then it is on the path back from the brink. You still have to look yourself in the mirror in the morning and ask yourself, do you trust the current political leadership in Turkey to follow through on that? And that's what I think gives people pause.
And there is also Russia.
Yes.
We read so much about Russia, know so much about Russia that we probably can't see any clear picture. What do barons think of investing in Russia in different senses of that word?
I think that's always the problem, isn't it? I can give you every opinion. I can give you a very clear opinion about almost any country in the world except the United States because I know too much. and often too much evidence is more confusing than helpful. I think in Russia it is clearly an investment story that is tainted overwhelmingly by the political story. Both the politics of what's going on within Russia and obviously the relationship between Russia and Europe and the United States. And so I think as investors are looking at Russia today, they see macroeconomic fundamentals that look pretty good. They see a currency that has seems like it's attractively valued. They see balance sheets that are stronger than they see in almost any other emerging market around the world. And their decisions that they make are less to do with anything going on in Moscow than what's going on in Washington. And whether or not a series of sanctions may not even necessarily affect one or another issuer as much as affect sentiment towards the Russian market. I think the case for Russia has to be that the politics starts to die down. But I think at least in the near term, in the US context, the president in many ways has lost control over Russia policy, and that has shifted to the Congress. And while Republicans and Democrats don't agree on anything, so far they have been voting overwhelmingly on behalf of many of these sanctions bills, which are particularly damaging because not so much that the measures in each bill is damaging or may be damaging, but because once Congress votes for something, it's very hard for them to repeal it. And I've seen that with the Jackson Vanik story, and I fear that that's a much longer term irritant in East-West relations that we have to deal with.
And given that the market situation in Russia depends on the Congress, what are your expectations about the new Congress?
So my expectations are more or less what is priced into what is in the polls and which is probably priced into the markets, which is that the Democrats will likely take control of the House, but not take control of the Senate. That means that we probably have 2 years of nothing happening in terms of major legislation, and giving everybody plenty of time to focus on the next presidential election campaign, which will launch probably in 2 months' time, the day after the midterm elections are done, when there will be a lot of Democrats running for office. I think what markets may not appreciate is if those polls prove to be wrong. And, for example, the Democrats fail to take the House. That probably will give a boost to financial markets in the sense that there will be at least a chance of Republicans controlling both houses of Congress for another 2 years, and a chance for the president, with Congress's help, to look at more tax cuts, whatever that does to our fiscal balance. But that is certainly part of their agenda, and to look at some of the infrastructure projects that they've been talking about. So that would be positive for financial markets.
Well, just to stop with my questions, I'm going to give the microphone to the small auditor. We have 2 last ones, and both of the area of the fantasy rather than the economics. The first one is obviously oil. We know now why oil dropped down from 120 to 30, for sure. We pretty much know why oil grew up to 80 from 30. What's going to happen next? What are the variants? What are the expectations? Given that I'm joking when I say that we know what happened, because saying that oil is 80 because Venezuela is failing to deliver oil is kind of a bad explanation for the process. What are your thoughts?
Well, the moving parts on the oil price include things like the Iran sanctions, of course, and to what extent those affect the global oil supply. Most analysts that I look to seem to think that will, of course, drive the price higher over the next few months, several months. I think the other side of things is, of course, on the supply side, where higher oil prices, particularly in the United States, lead to the prospect for new shale supplies coming on the market. And so those are the two things that I'm watching in terms of the supply. Of course, then you have to take into account your view on global demand for oil. Over the longer term, clearly oil will face some challenges from alternatives. I think broader issues around climate and regulation that favors renewables puts a damper on longer term oil prices. Now that when I talk about longer term, I'm talking about 10 years out or 20 years out. But to the extent that we might be surprised by faster than expected global growth, that would give you some upside. I think most people seem to be worrying about undershooting global growth expectations, given some of the themes that I raised earlier. So at least in the near term, the moving parts I think have to do with the United States and Iran.
Which means we don't know. The last question with regards to the interest rates. You mentioned it's quite obvious that interest rates are going to rise. The estimates can differ. The last 20 years average was somehow 6%. It's much farther than we have now, so there is still a long way to go. We obviously don't know when and with what pace, what speed it will grow. But then you've said that Barron's is investing in high yield bonds. We are investing in high yield bonds. It looks like the last resort in the market where the equities are overpriced and the long-term debt is dangerous. But how it corresponds with the fact that the interest rates would rise? If interest rates rise, the debt should fall, and the returns would be negative, or not.
Well, I think we looking at the high yield space in particular, and we're investing our clients' money in the high yield space. I think they see what we do, which is companies that are good businesses with strong balance sheets that are paying a good return in a low interest environment. And so that's the calculus that I think they make, and that's why I think that's been a space that has done very well. The issue is not so much, as how will they rise or not. It's will they rise along with expectations or not. And as long as they continue to rise according to the current expectations about Fed hike paths, a couple more this year, maybe 3 next year, I think we're in a very good situation. The trick is obviously that is wrong. The concern is obviously that is wrong. There is a lot of concern that they will have to tighten faster just because of what we've been seeing overall with good economic activity in the United States. But as I say, the inflation expectations have been low, have been moderate, and other than wage pressures, other pieces of the inflation basket have been well controlled. So again, yes, we are in a world of rising interest rates. As long as they rise slowly and in line with expectations, I don't see any reason for a big disruption. If we go back to 6%, I would predict that will be bad for the stock market, also the bond market, also the overall economy. But it is hard today to see what will drive us back to 6%. The last thing I'll say is just in terms of longer-term trends in demographics, in technology, again, in expectations, lead me to believe that inflation is sort of stickier at lower levels, and that the risk of it spiking back up to what we saw in the 70s and 80s is relatively low.
Well, I have to stop because I'm not alone in the room. Do you have any questions?
Okay. My English not so good as Russian.
I can translate.
Okay. Я хотел бы вернуться к Европе. говорили о Германии, и интересно, вы сказали, что Германия идет позади американской экономики, в том числе и по времени, и по мерам. А все-таки как долго, по вашей оценке, продлится еще цикл подъема в немецкой экономике? И особенно интересует ваше представление о состоянии финансового сектора Германии, банковского и в целом финансового.
Translation?
Unless the listeners need a translation. The German situation, I think, is very interesting in the sense that it is obviously a large economy. There have been some improvements in wage growth in Germany, and the domestic consumption picture has improved. When I say Germany has been behind the United States, I really mean Europe as a whole was late to quantitative easing and is now behind the European Central Bank is behind the Federal Reserve in terms of its pace of tightening. But I think going back to Germany, the issue is much more dependent on the global trade outlook because German economic growth is so much more dependent on its exports, and particularly its exports to emerging markets, and even more particularly its exports to China. So I think to the extent that there are risks and headwinds for the German economy, they will depend on whether or not this down leg we have seen in emerging markets continues, whether perhaps I am wrong and China faces a much bigger slowdown or sharper slowdown. I think that's the biggest risk ahead for Germany. In terms of the German financial sector, I think it's very differentiated. There have been a lot of questions, of course, around some of the bigger German banks, the international German banks. But my sense is that within Germany, the banks themselves have continued to lend to the small and middle-sized enterprises, and that should continue. So again, I think the risks are less from within Germany than they are from outside.
Ситуация в финансовом секторе Германии совсем другая, чем, допустим, в Италии.
Yes.
Absolutely.
Yes. The Italian. So it is much better in Germany than it is in Italy. Germany has faced its own issues with its savings banks, which have tended to accumulate some questionable debts that they've been able to roll over. But overall, the situation is much better than Italy, where the non-performing loans in Italy are around 12 or 13%, I think, right now. They've come down from 18 or 19% in Italy. But the ability of Italy in the legal system and the banking system to clean out its non-performing loans is much less than it has been in Germany.
May I ask one?
Sure.
In English?
In English, if you don't mind. 12 years ago, investors with a long-term perspective would have looked up the long-term returns on equities, bonds, and short-term debt and used that to predict the future. Interest rates went down, and many people said those long-term returns are not applicable for the future. So when you have an investor with, say, a 20 or 30-year time horizon, what are you saying to that investor?
I think the problem for all of us in this business is that we are forced to make 20-year predictions in a world that's impossible, for the most part, to see beyond a couple of months. But I think the longer-term trends, as I say before, as I look to things like demographics and technology and corporate profitability, it suggests to me that we are still living in a world of lower growth rather than higher growth and lower inflation rather than higher inflation. Part of what gets me to that conclusion is that if, with all of the fiscal and monetary support that we threw at the global economy after the financial crisis in 2008, we still, in the United States, got to 2, 3, Now we're sort of touching at 4%, but I think there's a lot of question as to how sustainable that is. If we can, if that's all we can do, then it's unlikely that we're going to do more than that as the monetary stimulus is pulled back. So if you are an investor with a big pot of money and a long-term time horizon, I think you have to reduce your expectations, both in terms of nominal returns and real returns. Although I say that with a lot of humility from all of the people who made predictions 10 years ago and were wrong.
Maybe ask an interconnected question about that. When we talk about the segmentation of the markets, many people say that the slow growth comes primarily because the standard economy, the historical economy cannot grow anymore at a high speed. But then we have segments or sectors which will grow and gradually substitute the traditional economy. Such segments as information technologies, for example. And when we look at the sector, when we look at the S&P 500, for example, we can say that it's overpriced because the PE ratio is kind of 26. But when we decompose it into the high tech with PE ratios over 100, and the rest is nearly undervalued. What do you think about this kind of decoupling of the economy? Is it a new bubble? Or it's a normal process of transformation of the economy? Is it recommended to invest in traditional segments because they are undervalued in the view of the hype and the information technologies, or else?
I think the technology sector is clearly very exciting, and it gets a lot of attention because it is exciting, and we all have these supercomputers that we carry around in our pockets now that change so many things, not just about communication, but information we look up, how we manage our personal affairs, whether it's financial or travel or others. And almost every business model has been transformed by the technological change that we are living with. Two things. One is the problem for economists and policymakers is that this technological change doesn't obviously create job growth. And in fact, in many sectors of the economy, it is job destroying, including in the financial services business, because you probably don't need to hire quite so many human analysts, even if you are not a quantitative investment strategy. You just don't need as many people to keep track of your analyses of various investments and relative returns. So technology is exciting, but it's not necessarily going to create the jobs that we want to have created for us. I don't think we're all going to be replaced by robots. I think there will be new businesses that will create jobs that we can't imagine yet. And that's the sort of exciting part of the investment business, is to see where those models develop and where jobs are created. The other side, though, when you talk about the old economy, the traditional economy, one of the things that we have seen, at least in the United States, is that in spite of a terribly destructive wave in the US retail sector, where old traditional retail chains have gone out of business, have lost business to mainly Amazon, but other online retailers. We're seeing some companies actually respond to those pressures and do well. So it's not all retailers, it's just the less nimble retailers that have done poorly. So companies like Walmart have figured out a way around it. Niche retailers like H&M, who is your neighbor here at the Carnegie Center in Moscow. So it's not just a question of avoiding the old economy altogether, it's finding the right companies to invest in.
Yeah, we are about to finish in a few minutes, and we need to attract the listeners somehow, and we need to ask hot questions at the end so that we can market them afterwards. One of the industries which is in hype now, obviously, is the industry of cannabis production. We here look at the industry as very attractive. Many Russians already invested in that. So, well, drugs is traditional Russian business. Maybe you can comment on what's going on in the United States and how you would value the perspective of the business.
Well, you've asked a really good question. You saw I had a chart that I showed you earlier that was the copper gold ratio. I'm thinking for my next investment chart, I will have a cannabis Bitcoin investment ratio, and I don't know what it will tell us, but I'm sure it'll be very interesting to follow. I think cannabis is like any new product that hits the market. It's not a new product, but at least in the US context, it is a new legal product. There's been a huge amount of money chasing into it already, so if you are just starting to look at it, you're probably late. I think the two issues are obviously where, like in any consumer product, where there will be a good product with the right branding, with the right distribution model. And I am probably not the person to point to any particular investment on that front. I will say, at least as the regulatory context improves dramatically in different parts of the United States, what we have seen is that at the federal and state level, things seem to be loosening up. But in many communities, even though it is legal to sell marijuana and cannabis-related products, towns and cities are not allowing it because of pressure from families, schools. They don't want it in their neighborhood, kind of thing. So it's been an interesting path that I think the rollout has been slower than people expected.
Well, you have another question? Could you take the microphone, please?
Back to the sanctions and trade wars. Imagine the situation. Some Russian companies are under very high pressure today. For example, aluminium companies. And they are ready to shut up operations, maybe very soon, but restart sooner or later with different suppliers and maybe with different settlement schemes, not based on dollar, based on Bitcoin, blockchain operations, or direct settlements between countries in local currency. What is your opinion about reaction of, as economist, of global economy on such challenges in the recent future?
Well, I have two reactions. One is, I think, in the near term, most of the issue around sanctions, I think, will be felt on Russian assets, and whether it's in the aluminum sector or other sectors. Again, the analysis, I think, on the part of investors is less to do with balance sheet and the potential profitability of a particular investment as much as it is it owned by somebody who might be on a list at the U.S. Treasury Department. So one is less a financial analyst than trying to guess almost something impossible in terms of the way the politics will play out. Clearly, sanctions have become a very an increasingly large tool in U.S. foreign policy with North Korea, with Iran, with Russia, and others. There are great concerns that if the tool is overused, it will lead to the behaviors that you describe, people looking for alternatives, governments looking for alternatives, and it's not inevitable that the United States dollar will remain the dominant reserve currency forever. But I would say that the problem for those looking for alternatives is that there just aren't very many alternatives, and that what a reserve currency ultimately needs is not a leader or a government saying my currency should be in the SDR basket, for example, at the IMF. It's kind of nice, but it's not going to change the way people look to it as an investment or a place to store value. What you ultimately need are deep, liquid financial markets, particularly corporate bond markets that can absorb large flows of money in and out of the country. And that requires legal institutions, regulatory institutions, things that develop over a long period of time. If the United States, for whatever reason, is no longer viewed as that place, the next best place, the next most likely place, is probably Europe. In spite of what happened, unless something dramatically different happens in Italy that I'm not predicting. But I think that's where the politics of the U.S. may be overusing its tools, is a question to be asked and to be debated. But the broader issue, if you're an investor looking forward over the long term, it's hard to see another alternative emerge without some of that very difficult infrastructure being put in place in other countries.
I've heard a couple of times in Russia, so forgive me for such a local view, the idea of creating a global cryptocurrency, kind of a thing which is adopted by all the countries, all the nations in the world, and which is independent from any central bank and just reflects the composition of the exchange rates, but does not allow any country to voluntarily prohibit to trade or stop the actions of the other countries. It's like a United Nations issued token, which will be freely convertible to any currency in the world at the current rates. Have you ever thought or heard or spoken about that in the United States, or it's not on the agenda?
So I think there are a lot of cryptocurrency alternatives that come into the conversation when we talk about sanctions, when we talk about the dollar. Even people who don't worry so much about being sanctioned, but they just don't want their financial transactions tracked or taxed or monitored. You've been in similar conversations, I'm sure, with people who are very interested in cryptocurrencies. It is almost, they have a political agenda as much as an economic agenda. I think you just have to come back to, I'm not sure how the international crypto token would work, but you have to just ask yourself as an investor, if you have to put all of your money into a single currency for 25 years and not touch it, are you going to put it in the crypto UN global currency, or are you still going to keep it in the dollar? It's not to say that your answer may not change in 20 years, but I think today the answer is still overwhelmingly the dollar. You may choose the Swiss franc or the Canadian dollar, but those are, for other reasons, those are smaller currencies. Unless you have $1 trillion to invest, they could probably absorb your savings. But I'm not sure that a new cryptocurrency is going to answer that problem.
By the way, what do you think about euro? Short-term perspective of euro.
The euro? Well, again, just as I made an oil price prediction, I don't necessarily like to make a currency prediction, but I think the euro has sold off. I think the dollar, you've seen it adjust a little bit lately. I think if we get better economic news out of Europe and the Brexit and Italian concerns pass in the next couple of months, you could see a picture where both confidence in Europe and some of the macro numbers support a readjustment in the exchange rate. But that's a prediction that's about as good as any other prediction that others would make around this table.
Okay, thank you very much for your attendance, and we are about to quit. Christopher, thank you very much for the thoughtful presentation, and we will use it in our media with your speech. We will try to compose something.
Okay, good.
Thank you very much.
Thank you.